Hi, welcome back. These last few sessions we've looked at information trading, trading following insiders, trading following an analyst, and in particular trading on public information, but we focus just on earnings announcements. In this session I'd like to focus on other kinds of public information that you might be able to trade around, and also set the table on what you might need to do to be successful as an information trader. How do you make money trading on information? So let's look at a second big announcement. For many companies, one of the biggest announcements you can make is an announcement that you're either being acquired or that you're acquiring somebody else. As a stockholder, I know which side of that equation I'd like to be. If you look at stock prices around acquisition announcements, it's quite clear who the winners are and who the potential losers are. The winner is always the target company stockholders. If you can be a stockholder in a target company, you're clearly going to come out way ahead in this game. Because as you can see, on the date of the announcement, the stock price for the target company jumps in the announcement. For the acquiring company, of course, the returns look much less attractive. So we'll take a closer look at acquiring company stock prices, but if there is a company where you'd like to be a stockholder, it's going to be the target company. Here again, as with earnings announcement, notice that the price starts drifting before the actual day of the announcement. So the actual day of the announcement is day 0. The bulk of the jump happens that day, but the prices start drifting 10, 15, 20 days before. Again, evidence that information is leaking out, that somebody's trading ahead of the acquisition announcement. Now, if you look at what happens to target company stock prices, clearly target company stock prices jump on the announcement of an acquisition, but how much they jump can vary depending on how the acquisition is structured. For instance, in this particular table, I've looked at 3 different categorizations of acquisitions. The first is tender offers versus mergers. And you can see that tender offers actually deliver much higher returns to target company stockholders than mergers do, that cash offers deliver much higher returns than stock offers do, that hostile acquisitions deliver much higher returns than friendly deals do. Now, if you ask me, would I rather be a stockholder in a target company or not? Of course, I'd like to be a stockholder in a target company. But this allows you then to slice and dice being a stockholder in a target company and think about what types of target companies actually deliver the higher returns. But you might be being greedy. No matter how you slice this, no matter what kind of deal you're looking at, if you're the target company stockholder, your stock price is going to go up by 10, 15, 20, 25%, and depending on how the deal is structured, more rather than less. Now let's look at the more interesting side of the equation. What happens to the acquiring company stock price? Now if you look across the years at studies that have looked at this phenomenon, they come to mixed results. Some of the earlier studies from the 1980s basically concluded that the acquiring company stock price goes up a little bit, 2%, 3%, but on average acquiring company stock prices go up on the announcement of an acquisition. As these studies have continued over the last 20 or 30 years, you've seen a drift down in that number. In fact, the average returns in the most optimistic studies that I've seen from more recent years come up with either 0 returns or just barely above 0, and some of the more pessimistic studies find that acquiring company stock prices on average tend to drop. But even if you look at the most optimistic studies of acquiring company stock prices, what you discover is a big subset, as many as 50, 55, 60% of acquiring companies see their stock prices drop on the announcement of an acquisition. What does that tell you? What it tells me is that market participants, investors, are a lot more pessimistic about the potential success of acquisitions than managers are at the time of the acquisition. In fact, if you listen to the acquiring company's management, it always looks like a good deal, right? Every merger. And investors are saying not so fast, that at least based on what they see, they don't see the good stuff. Now, of course, managers would always come back and say, well, those investors don't see what we do. They don't have access to the information we do. And that might be true. But there's some very interesting evidence after the acquisition that actually suggests that investors are more often right than managers are. And these studies look at what happens in the years after the deal. And here's what we find. Most mergers don't pass basic financial tests. McKinsey, for instance, has done studies over time where they looked at acquisition, and one of the first ones they looked at acquisition programs between 72 and 83. And they looked at, I know it's an old study, but kind of hang in there anyway. And they looked at 2 questions. One is the return, did the return on the amount invested in this acquisition exceed the cost of capital? That's a fundamental question you ask about any investment. Does the return on capital exceed the cost of capital? And second, since so many of these deals are presented as deals that will help you get better against the competition, did you start performing better against your peer groups after the merger? And McKinsey in that study found that about half of the programs they looked at, and these are programs, so these are companies that do a bunch of acquisitions, half the programs failed both tests, and 6 failed at least one test. That's pretty bad news. In fact, another follow-up study they looked at found that 60% of the transactions they looked at, these were 115 mergers in the UK and the US, 60% of the mergers earned returns on capital less than the cost of capital. In capital budgeting terms, 60% had negative net present value. That's a pretty terrible track record. And finally, KPMG study that's been updated every year since looks at a very specific phenomenon. Since so many mergers are sold on the phenomenon of synergy, they ask the question, how many of these deals does synergy actually show up? And one of the first studies they looked at, 83% of the mergers they looked at, they found no evidence of synergy, or worse, they found reverse synergy. Combining the companies reduced their value. As I said, they've updated these studies all the way through 2012, and you can find the most recent study on their website. But their basic finding hasn't changed, which is in most mergers that are sold as synergy-producing mergers, the synergy doesn't show up for one reason or the other. And in fact, in the most damning evidence that acquisitions don't work, many get reversed within 2, 3, 4 years. In other words, a company does a deal saying it's the greatest deal on the face of the earth. 2 years later, it reverses the deal saying it didn't work out. In fact, Mitchell and Len found that 20% of the deals done between 82 and 86 were divested by 88. 92 study, Kaplan and Weisbach found that 44% of the studies, the mergers they looked at, were reversed because the acquirer paid too much or because the two companies could not operate together. And over longer time periods, it gets worse. About half, maybe higher. A larger percentage of acquisitions get reversed within a decade of the deal. So companies, by reversing these deals, are telling you, hey, we sold you a bill of goods. It didn't work out, and we're getting out of the deal. And here's an interesting fact. A lot of these reversals happen when a new CEO comes in and says, hey, that old CEO made the mistake. I'm reversing the mistake. So if you're an investor looking at an acquisition from the outside, there are 3 classes of strategies you can adopt. The first and the most lucrative strategy is to try to find companies that are going to become target companies. In other words, invest in companies that will become target companies in acquisitions. By far, the most lucrative strategy built around acquisitions. Tough to do because you got to then predict which companies are going to get taken over. Here's a strategy that's tried more often, though with mixed results. Wait till an acquisition is announced and either buy the target company or the target company and the acquiring company, and then hope to make money on what you see as the drift up. What you're betting on is the following: that in many acquisitions, an acquirer announces a price and is forced to raise that price a little bit to get the deal done, and you're trying to make that difference. The risk you run is if the target company plays hardball, it's possible that the acquiring company might walk away from the deal. But you're assuming that most of the time these deals are going to go through and that you're going to make the extra 4 or 5% difference between the original acquisition price and the final price at which the deal gets done. This is called risk arbitrage. I think it's a misnomer because it's really not arbitrage. It should be called merger speculation because you're coming in after a deal is announced and speculating that the deal will get carried through at a higher price. And there's a final strategy. It's a long-term strategy you can adopt, which is to buy after what you think are good mergers, where you think that the combined company is actually going to create more value than is being built into the values at the time of the acquisition, or sell short on all those bad mergers we talked about, which is sell short on the company and saying, hey, this deal isn't going to work out, the stock price is going to drift down. So let's look at least the most lucrative strategy. Is there a way you can find potential targets before they become targets? I think so, because studies have looked at typical target firms and acquisitions, at least in hostile acquisitions, have found the following characteristics. First, These are companies that have underperformed their peer group, the rest of the sector. So if you look at their stock price performance, their stock prices have done a lot worse than the peer group. They're often less profitable in terms of margins and returns on capital than other companies in their peer group. They're companies where insiders, the managers, tend to hold far fewer shares in the company. They have a lower insider holding than other companies in the group. And they often trade at much lower price-to-book ratios or price-earnings ratios than other companies in that same sector. So that's what the evidence suggests. So here are the two ways in which you might be able to use these findings to find potential target firms. Remember, we talked about screening in value investing. You could run screens, and here are the screens you could run. You could screen for companies in every sector that have underperformed in terms of stock price, have poor profit margins or returns on capital, have low insider holdings, and look cheap, have low price-to-book ratios or low price-earnings ratios, and invest in those companies. In essence, this is really a value investing strategy where your exit, where the way you make money off your stocks is not so much from the companies recovering in the market, but from somebody else coming in and buying the company off your hands. The second and slightly more sophisticated strategy is try to attach a probability to your company that will be taken over. Saying, how am I going to do that? There's actually a statistical technique called a probit, where essentially trying to estimate the probability of an acquisition based on observable variables. The observable variables will include the items we talked about. How badly the stock has done, how profitable it is or how unprofitable it is, how low the stock holdings are. So essentially it's like building up a regression equation, but instead of predicting a dependent variable that's a continuous variable, you try to predict the likelihood that this company will get taken over. A little more difficult to do, a little messier, but if the payoff is great, and it should be great if you can get the right target companies, then I think it's worth thinking about. It's a way of estimating the likelihood that your company will get taken over. I'm not going to talk much about merger speculation / risk arbitrage because it's an inside game. It's a game that most of us as outside investors can't really afford to play, but if you're an insider in the game and you can see what's going on within the process, maybe you're close to the investment bankers and you can get a sense of the likelihood that the deal is going to go through, then perhaps coming in after a deal is announced and trying to make money off that little jump in the price between the original announcement price and the final deal price might make sense. But for most investors, I don't think it makes sense. And even for professional investors, I think it's become a high risk, relatively low return strategy. The final way you can try to make money is to actually try to look for mergers that work. And here again, there is some evidence you can draw on. I gave you the overall evidence in mergers. It's not that good, right? Most deals don't work out, but there are subsets of deals that seem to work out, subsets of acquisitions that seem to work out. Here are the places where you're going to go if you want to improve your odds of success. You're going to go towards hostile acquisitions where the management is replaced. The odds of making money on those deals seems to be higher than in friendly mergers where the management stays around. You're going to go towards mergers of like businesses than mergers of unlike businesses. There seems to be a much greater chance that you get cost-saving mergers, which you get out of like businesses than out of unlike businesses, than growth-oriented mergers. Acquisitions of private businesses seem to have a much better payoff than acquisitions of public companies. And mergers where people have actually put their plans down on paper, where there's a clear sense of what the cost cutting is going to be, seem to have a better shot of succeeding than mergers where that's not done. So if you can look at a merger and say, hey, in this merger the pieces are in place. And one final thing, mergers of equals seem to be less likely to work out than mergers of unequals. So basically, if you can find a convergence of these special forces that make a merger more likely to succeed, you might be able to make this part of your long-term screening strategy. You want to buy companies which do good acquisitions and sell short on companies that do bad acquisitions and hope to make money off that post-merger performance or non-performance that comes out of this. So if you look at acquisitions, basically that's the way to play the game. If you can, try to get ahead of the game, try to find companies before they become targets. But if that doesn't work out, see if you can play the long-term game on acquisitions that work out. Second set of announcements are stock splits. Stock splits should be neutral from a value perspective. All you're doing is changing the number of units in a company, right? And if you look at the overall evidence, that seems to be what comes through. If you look at what happens to stock prices around stock splits, there isn't much of a price reaction. There might be a signaling story that can be told where investors look at a stock split and say, that's good news because only companies that think they can see their earnings continue to increase will split stock. But that's a very weak story because anybody can split their shares. In fact, the big news with stock splits is when they happen. They tend to happen after a price run-up, not before a price run-up. So in some ways, a stock split can be viewed almost as a negative signal because when a fast-growing stock splits its stock, what it might be signaling is the good days are over, that now we're in a stage of kind of mature growth and things are not going to keep going up the way they did. So to look for tea leaves in stock splits is, I think, a little dangerous. But if you can find a way to incorporate stock splits in some other strategy, maybe there's a way to make it work. What about dividend changes? Well, the overall evidence, again, is pretty strong that when you see a dividend cut, that's bad news. Stock prices tend to drop on the announcement of a dividend cut. And on average, when dividends are increased, it's good news. Stock prices go up. Now, again, you can think about nuances on the strategy where some dividend increases are bad news. A high growth firm that announces an increase in dividends might be signaling that things are not good, that opportunities are starting to dry up. But on average, if you look across time, increases in dividends are good news, decreases in dividends are bad news. In fact, cuts in dividends are more bad news than increases in dividends are good news, partly because far fewer firms cut dividends than increase dividends. But there are some interesting changes that have seemed to have happened under the surface. This is actually from a study that looked at the reaction to dividend increases and decreases across time. First, looking across all 3 time periods, notice that dividend decreases have a much bigger impact on the stock price on the downside than dividend increases have an impact on stock prices on the upside. That again is because dividend increases are far more common than dividend decreases. But here's the interesting sub-phenomenon if you look across time periods. Dividend increases and decreases seem to have become less informative over time. If you look at the most recent time period, for instance, in this case the 1990 through 2000 time period, or the 1988 through 2000 time period, the price reaction to both dividend increases and decreases seems to have dropped off. So there are lots of reasons this might have happened. One reason, I think, is as companies increasingly turn away from dividends to buybacks, dividends have become less useful as a way for companies to signal to investors how they will be doing. So for better or worse, if you're incorporating or building an investment strategy based on dividend changes, that strategy is probably less effective now than it was 10 or 20 years ago. And that's something to keep in mind as you think about information-based strategies, is over time they can evolve, they can change if the information you're building a strategy around has become less effective over time, or less followed over time. So let's assume that having looked at all the evidence, you decide that you are either going to build a strategy built around information announcements or incorporate information announcements into another strategy. Here are 5 things that I think you need to keep in mind. First is, you have an information-based strategy, be very clear about what that information is going to be. So if you're building a strategy around earnings announcements, be specific about what you mean by a positive surprise or a negative surprise. What are you going to use as your measure of expected earnings? And that's critical because you can't wait till the information has come out to make that judgment because things have to be done quickly. So do it ahead of time. Specify what you mean by information. Second, build an information system that is built around delivering the information to you instantaneously, as quickly as you can. So if you're going to trade based on earnings announcements, then you want a system, or earnings revisions, or whatever, you need a system that delivers the information to you quickly, at least quicker than it does to the rest of the market. Even a 10 or a 15-minute advance notice can be helpful. Third, you got to execute quickly. You can't sit there waiting for in fact, we looked at the evidence. If you wait 3 hours after an earnings announcement comes out, it's already too late. So you need to trade quickly. So you need a system that delivers the information to you, and you need a system that puts in a trade almost instantaneously. And while you're doing that, and this is a tough test, you want to keep a lid on transactions costs, because even if your strategy is successful, remember you're talking about relatively small amounts of money. So positive earnings surprise doesn't make your stock price go up 30%. It might make it go up 2 or 3%. So you want to keep your costs under control, otherwise your returns will disappear. And finally, if you have an information-based strategy, not only is it critical that you buy quickly right after the information announcement, it's also critical that you know when to sell. You almost have to build a strategy that gives you triggers as to when you will sell. It either has to be preset, so you're not sitting there trying to pass second judgment on yourself, or it's got to be based on some observable measure. So using the earnings announcement example again, you might say, look, I'm going to buy after positive surprises. I'm going to hold exactly 2 weeks, because that's what studies suggest is the peak period for the drift, and then I'm going to sell. And you have to be disciplined. To make money off an information-based trading strategy requires speed, and it requires discipline. So in summary, in this particular session, we looked at non-earnings announcement public information, and we looked at acquisitions, we looked at stock split, we looked at dividend announcements. It's not a complete list. There might be other public announcements you can build your investment trading strategy around, and that's part of the reason, we talked about these final five factors that might determine whether you're successful or not with an information-based trading strategy. Thank you very much for listening.